This is The Wealth Puzzle with Michael Mansfield from the Lynn Group. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Michael provides his clients and prospects with the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful solutions to put you on the path to achieving your retirement goals. And now, here is The Wealth Puzzle with Michael Mansfield.
Hi, everybody, and welcome back to The Wealth Puzzle. It is me, Owen, again. I will be putting together a really awesome video for us today. A lot to talk about. A busy week for headlines, a busy week for economic indicators. We've got GDP tomorrow. We've got big tech earnings later today, Amazon, Microsoft, even Google, I believe. So really a ton going on, a lot to talk about, a lot to digest. We'll try and tie everything else out together. But man, really crazy is what I should say. Really crazy weather we're having in Texas. For those clients in California, you might have seen it on the news. It seems like every other day we're getting a tornado warning, a severe thunderstorm warning. I mean, it's been eventful. It's been unique, exciting to some degree, but a bit scary. So if you're in California, enjoy the calm, consistent, beautiful weather. I know I am saying that literally every video at this point, but don't take it for granted because you never know when you're going to have a crazy run on weather. So Texas clients, hunker down. It's spring. We've been through this before. It'll all turn out okay, and stay safe. So, all right, let's talk about some really interesting things going on. I'm going to start with OPEC, actually, surprisingly enough. There's a couple of things happening in the Middle East. So OPEC recently announced that they will be leaving, or excuse me, UAE recently announced that they will be leaving OPEC. So this is a huge signal for the oil market. So essentially, UAE is saying, look, we don't want the restrictions on oil production, and so they want to be able to produce as much as they want and try and control prices themselves. This loosens the grip that OPEC has on the global oil prices. So this is you could say one of the dominoes that's beginning to fall due to the Iranian conflict, the Strait of Hormuz. So could it have been, is it a symptom of the Trump administration's influence in the Middle East? I think so. I think that's a pretty reasonable thing to say and assume. But we'll definitely have to see how things continue to shake out there. We do know that as of today, the Trump administration did turn away or deny the latest peace plan that came out of the Iranian regime. A lot of that has to do with the fact that Iran is just not willing to compromise or make concessions on the enrichment of uranium that they do currently have. You see, the Trump administration seems pretty firm or consistent with their agenda to keep nuclear weapons out of the hands of Iranians. It's one thing if you're going to use nuclear fission for power. It's another if you're going to be using it for terroristic activities. So the Trump administration standing firm and tall on that one. We'll have to see what else continues to pour out. We do know that as of right now, peace talks are still on. The ceasefire is still there. The U.S. blockade on the Strait of Hormuz is still in place. So all of those things are still on the unknown side. But I think things are pointing towards something positive happening, for lack of better words. We're looking at the potential for some sort of agreement. It seems like both sides are in some way willing to make a deal, cut a deal. It just depends on who will be the first to draw the first concession. Hopefully it's the Iranians, but we will see how that all plays out. But let's talk about the U.S. So a lot of economic indicators did come out. I'm going to throw this one up on the stage here. What I want you to pay attention to here is durable goods right here. I'm losing it. Oh, it's right here. Sorry. So durable goods up 0.8%. The forecasted value was 0.2. The previous was negative 1.2%. So this is a fantastic reading. This is beating analyst expectations. This is proving that companies are continuing to produce, companies are continuing to order. Inventories is also up. And so you can kind of try and make the argument, is it that companies aren't selling things, or are they producing and selling so much that they have to actually increase the level of inventories that they have? That's a bit of a confusing dichotomy happening in retail inventories and durable goods orders. But the overall sentiment here across all of these different housing starts, building permits, trade balance, all of that stuff is pointing towards an economy that is being resilient. That is the word of the day for the U.S. economy: resilient. It's refusing to break, and so this is all pointing towards good news. I think this is a positive reading. Actually, I know this is a positive reading. The one that I really want to focus on for tomorrow, again, busy week for economic indicators and earnings, is GDP. So we get Q1 GDP reading tomorrow. The median forecast is 2.2%. But if you go to the Atlanta Fed's nowcast, it's just another place where you can kind of get an idea of what the expectation is. They're saying 1.2% growth. So whether you take it at 1.2 or this 2.2, overall, we're expecting a growth. Now, if we get an earnings beat, so we get slightly higher figures, this could be really productive for the U.S. economy. And we'll talk about why that is in just a few minutes. Obviously, we want GDP as high as it can be, for as long as it can go. But when you couple the fact that the stock market is sitting relatively flat, 4% year to date, and there's been so many things happening with the latest headlines of the Iranian war and the price of oil, tariffs, all of that stuff. The fact that the economy is still growing, that the markets are still staying resilient, gives us a really optimistic forward projection. So pay attention to GDP reading tomorrow. That'll be a really intriguing one to see how that plays out. But, time will tell. What I want to move over to right now, real briefly, is the Federal Reserve. So, as you guys may be aware, the Fed decided to hold rates steady. They did so by keeping rates at 3.5 to 3.75%. That was sort of already baked in. The economy, the markets assumed that was the case. The expectation is higher rates for a little bit longer. I think they're trying to be cautious here. They don't necessarily feel that they have all the information to make a decision on cuts at the moment. And so when you get a new Fed chair in the next month or two, I think actually next month, things might change. Now, what's interesting here was there was 4 dissenters, which I guess for the first time since the late 80s or early 80s, this is not happening. So you're seeing a sort of call it a shift in the views among all the different Fed chairs. So we'll have to see how things continue to play out with the Fed, where they decide to go, whether they decide to cut once or twice this year or continue to hold rates steady. The market's expectation is that we will get a cut. And so you can see that being displayed in the U.S. Treasury yields. I could probably bring that up over here. They're sitting at about 4.4%. That's the 10-year Treasury yield. So basically, Treasury yields, the bond market saying, hey, we expect rates for longer, as I've said the last few seconds here, rates for longer, but more importantly, the bond market believes that the U.S. economy can handle rates at this level. They're betting on the market or on the economy growing. So the bond market showing positive signs. The Fed is sort of playing the nobody move, don't break anything. and we'll see what happens as we get more economic indicators, economic readings to play out. We do know that a lot of the inflation is being driven by the Iranian conflict, the price of oil. Jerome Powell did go on and talk about that well, honestly, as I'm recording this video, about 20 minutes ago. He did admit that a lot of the inflation that we are still seeing is directly from the Iranian conflict. So as something like that starts to unwind, you again get another positive catalyst for the market to really take hold. Now, this is, I think, where the conversation tends to shift. We're going to talk about why I think there's a lot of opportunity in front of us. I talked about I talked about some of these economic indicators being positive. I talked about how GDP, depending on what we get, could be a really positive thing. And then consumer sentiment. If you can look at this chart, consumer sentiment is sitting at an all-time record low. Well, as far back as this chart will let us go, I think the last reading I saw was 49.8 last month. So what this chart is telling us is that the consumer and the U.S. consumer is pretty unsure about the market. They don't feel good. They're not going out and partying about how awesome the economy is doing. But if I go back to the S&P here, let me share this tab. Year to date, we're seeing 4%. Over the last year, if you can see this green little box, the S&P is up 28%. So if the consumer sentiment is at all-time lows, but the market is relatively flat and if not positive 4% year to date, imagine if we get good news from GDP, we get a peace deal in Iran, and you get all of those things happening relatively over the next couple months, the market could have a really strong rally. And so I think at the Lynn Group, we're pretty optimistic about things. I should say about how things could play out. Again, this comes down to timing. Sentiment is low, but at the same time, the economy is proving to be really, really resilient. So it's more of a matter of when and what news we get rather than if. I hope that's helpful. We talked about a lot of really interesting things, a lot of different headlines, a lot of crazy stuff going on, and there is much, much more. There is plenty to talk about. And so as it continues to funnel out, we'll try and produce some more videos talking about what we think that means for the markets, for you guys. But until next time, thank you for tuning in, and we will see you guys soon.